But what I do emphasize with folks is make sure that you're not changing your investment philosophy based on what the market's doing. Welcome back to Invested in You, brought to you by Community First Investment Group. We're here to help you take the next step in your financial journey, no matter where you're starting from. I'm your host, Nate Hasto. If you're new here, welcome. You can always go back and listen to some of our older episodes at your own pace to get fully caught up. This week's episode might save you a few headaches down the road. We're talking about investment mistakes to avoid and some of the most common pitfalls we see, as well as how you can sidestep them. This is probably one of my favorite topics so far, simply because it's a piece that we discuss with clients and prospective clients every single day. And I'll start with some reassurance here. Everyone, and I mean everyone, can make mistakes. Seasoned investors, brand new investors tend to make more, but we're all human. So I think step one is just understanding that you're never going to be perfect here, but there are some common ones that we can definitely help make you a little bit more aware of so that you can avoid them in the future. A really common thing that I tend to see chatting with folks about misunderstandings, misconceptions when it comes to investment advice that they've received is really being careful who you listen to. Learning from others' mistakes is an extremely wise and valuable thing to do, but you do need to kind of run it through a bit of a screen first before you decide to take anyone's advice. The goal here today is to help all of our listeners build smarter habits, create more confidence, and we hope that some of these examples will really help to guide your next steps. So mistake number one is a really common one. We have folks that are interested in timing the market. And this is what I'll say to begin. There is no hard and fast, true, guaranteed way to time the market. It is, in essence, a little bit of a crapshoot if you're trying to pick and choose exactly when you get in or get out of the market. The professionals whose full-time job is to manage money, both from the financial advisor side as well as the portfolio manager side of things, they don't even nail it 100% of the time. You can check on things like quotes from Warren Buffett, and he'll tell you it's not about timing the market. And at the end of the day, the thing that you need to focus most of your time on is time in the market. Mistake number two is an overall lack of diversification. This is probably, in the years that I've been in the investment industry, this is probably one of my favorite challenges that people will bring up, especially if they aren't investing at all. They'll talk about how they have a friend or a family member who lost everything in the market. And that's always been so interesting to me when they bring up, because the number one thing that always comes to mind is, well, if they lost everything, it must have been a very concentrated position. It must have been everything in one stock. It must have been everything in one mutual fund. But if you start to dig further into the claim that they or someone they know lost everything, it becomes even more confusing. I went back and started to look at some of the market data just to try and bring something to you guys that's extremely pointed and relevant here. And the period of time that I pulled up that I believe is closest to what they've described as this friend or relative that lost everything is the Great Depression. Now, what I will say is the vast majority of people who bring this up to me are most likely not talking about someone who lived and was invested through the Great Depression. For those of us that may not be history buffs, Great Depression is the early 30s. So if we look at a stock index from the Great Depression period that was relevant at that point, still is now, the Dow Jones, from 1929 to 1932, the Dow Jones index was down 89%. I'll be the first to tell you that's a lot. Hence the Great Depression, right? But still, it's actually not a loss of everything. Now, I'm sure you can find companies who went under, who people had bought or sold stock in, and that's a different story. But that's truly one of the reasons why diversification is so important. You do have to work pretty hard if you're in a diversified portfolio to see these types of losses. And the reason for that too is because you have multiple layers of management and oversight that are occurring. So if you're not selecting individual stocks, you're going through the process of using a diversified ETF or mutual fund portfolio. You have potentially your financial advisor that you're working with to make sure they're seeing the oversight of the entire portfolio. How are you allocated? What types of funds are you using? Does it match risk tolerance, which is something we'll talk about in the near future? But then you also have the fund managers themselves. Your advisor, as well as the fund managers, are incentivized to not lose massive quantities of value or money in this case. So there really would have to be a lot of things that went wrong all at once across the board for you to truly lose everything. But that lack of diversification could bring you to a spot where you have really large drops in your portfolio value. Item number 3, emotional investing. Suffice it to say that the stock market is not a place to get in touch too deeply with your emotions. It should be a very logical place that we operate. I won't tell you that emotions never play a part in the growth or loss of value in the stock market. That it's involving humans, so it's always going to have an emotional aspect. However, what we really want to help people avoid is panic selling during downturns or chasing hot stocks during investment booms. One of my favorite questions to ask someone who brings up some concern and kind of we're getting onto the emotional side of things is, if they're interested in selling, we'll say in a market downturn, my favorite question is, step 1, listen, right? Because the emotions themselves are real. People aren't coming to, at least my impression is not that people are coming to me and sharing false emotions. So step 1, we need to really make sure that we take the time to listen to what people have to say. That's a big part of the job as an advisor. But step 2 is to try and help them process those emotions, right? And the question that I love is to have them ask themselves, is this what I think or how I feel when it comes down to, do I want to sell? Do I want to have all of my money in cash again? Do I want to accept a lower price than what I paid? Whatever the case might be. And about 9 times out of 10, just slowing down, asking ourselves those questions, gets us to a spot where we can start to put ourselves in a really rational frame of mind, put things in perspective, and make sure that we make a decision that we'll be happy with in the future. So emotional investing is not the recipe for success, but sometimes it's good to have someone outside of yourself being able to have you work through these thoughts and these questions together. Number 5 is ignoring risk tolerance altogether. This is usually more common with newer investors from what I've noticed. A lot of people will kind of get out ahead of their skis, if you will. They think that investing is a little bit more like gambling. They're chasing that hot stock, so some of it can be emotional. But really where it's coming back to ignoring risk tolerance. And really what you want to do here is you want to make sure that you're matching your personality or your personal comfort or even your experience level with the level of risk to go along with the timeline that you're planning on staying invested. One of the ways that we're helping folks with this is practically step 1, once we've kind of gotten to know who we're working with and a little bit about what they're trying to accomplish or what challenges they might have had previously. We go through and do a risk profile for them. Now, if they have money invested already, this is very easy. It's a way for us to kind of extrapolate what they have right now and show them some different outcomes. What I tend to like to do is talk through average market returns for different portfolio allocations they may have already, as well as recent major downturns and what that same portfolio might have looked like. Now, I'm usually not going back to the Great Depression in these examples, but I do tend to like to use the Great Recession since it's a little bit more of recent history. Ultimately, having that risk profile and making sure that your portfolio is aligned should avoid some of the emotional impact of changes in volatility in the market. Point 5, neglecting fees and costs. Now, there's always a cost to doing business, right? So for folks who are looking for free insight, free guidance, there's the whole internet out there for you. I think we'll touch on that in a later point here. But keep in mind, it is not personalized advice. So if you're looking for something personal, there's always going to be some semblance of a cost that comes along with this. However, I think being mindful of what those costs are and making sure that the information is covered, and if it's not covered, being comfortable asking is an important thing that you can do as an investor to make sure that you understand this. Some examples of some of the fees or costs that might not be terribly evident. If you're investing in funds like ETFs or mutual funds, there's something called an expense ratio. Even though you may not be seeing a commission charge or a transaction fee, being invested in these diversified investments does have an annual cost. So understanding how to find the expense ratio, making sure that it's a reasonable cost for what you're getting from the fund. Again, this is something that a good advisor will spend time looking at for you and will happily share with you if you'd like to dive into the weeds on how your funds are being spent. Second, I've run across this quite a bit recently, and it tends to be a little bit more of an old school style of investing and investment management, but there are still plenty of funds that exist and or advisors that operate in a way where they're charging commissions or there's sales charges involved with purchasing mutual funds, ETFs, things of that nature. So understanding what those costs are, how it applies to your situation, and does it match up with the type of investment relationship that you're looking for from a potential advisor is also key. And that's something we always spend time educating clients on, or prospects on. What are we choosing as far as our service model? What do we get for the money that we're spending? And let's just make sure it's a mutually beneficial relationship. The next option on here, or next question rather, is how do we make sure that we avoid the pitfall of not having a clear goal? Investing without knowing why you're investing is probably one of the easiest ways to get misaligned or derailed. This is where more emotion can come in. This is where ignoring risk tolerance comes in. This is the concept of beginning with the end in mind, right? So when we think about this, step one, and this is why risk profile is step two, and goals and understanding the folks that we're working with is step one. Goals help us create a use-by date for those funds that we're planning on investing. There have been plenty of times that I've actually encouraged folks not to invest specific funds that they were initially planning to. And oftentimes it's not because they don't have enough risk tolerance to invest. Oftentimes it's not because I think they're too emotional of a person to invest in this way. It's simply because the timeline that they're operating on is not appropriate for putting money into the market. No one has control over the whole market, so ultimately we can't control if this is going to be a positive or a negative scenario. But the longer time horizon we have, the more likely it is that we're going to see growth opportunities. So having that use by date can help really guide, should I invest this, and if I'm going to invest this, what types of investments are appropriate. The last one is putting off investing altogether. And this is an interesting one too, because I'd say this is probably up there, top 3, top 5. And by putting it off altogether, I mean waiting for the perfect time to get invested, waiting for the market to drop before they decide that they're going to put some money in. Pulled some interesting stats on this one that I think really illustrate this well. If we look for market drops, for instance, maybe that's something that we're interested in waiting for. Which again, this kind of comes back to timing the market versus time in the market, right? But markets on average will drop 10% or more about once every, call it just about 2 years, 1.87 years, which is not terribly often in the grand scheme of things. You do see smaller corrections throughout. It's certainly not a smooth line up. But if we consider that the average bull market, which for those of you who aren't familiar with the vernacular, bull markets are where markets are trending up, bear markets are where markets are trending down. But the average bull market usually lasts just about 5 years, about 61 months. And in an average bull market, it usually gains, the S&P 500 that is, usually gains about 184% returns during an average bull market. So if you consider maybe you are starting to think about investing at the beginning of the bull market and you wait about 2 years out of the average 5 that's going to be available as far as average growth runs are concerned, you're missing potentially 40% or more of the growth that's available on the table just because you wanted to try and get that slightly better price and wait for it to drop 10%. Again, all personal choice, so we never tell people that they can't do what they want to do on that side of things, but our advice would be, on average, get invested, do it wisely, do it consistently. And in a perfect world, you're doing some dollar cost averaging to go along with this if you're a little nervous about maybe it's too high right now for me to make money easily on this. We've covered that in a previous episode. So if you're wondering what is dollar cost averaging, take a peek at some of our previous episodes, and that should be helpful. When it comes to some real life examples of this, I don't want to get too specific on this, but I think I have covered a lot of examples already. I really like to share a little bit of an analogy when you think about investing, specifically retirement investing, but this can apply in almost every case. A lot of times when people think about investing money, what they have in their mind is day trading. It's glamorized. There's movies about it. You can find, if you search on YouTube or any of the other sources, you can certainly find folks that are usually sharing all of their wins and excluding all of their losses on things like day trading. But retirement and long-term investing should be treated, in my opinion, like grilling a steak. And if you've never grilled a steak, I'll just kind of walk you through this process, right? It's the same process every time. Really what you're doing, you're bringing the grill up to heat, right? So we have this methodical process. You're bringing the grill up to heat. You're making sure that the steak is room temp, ideally. You're marinating it if that's what you're planning on doing. When you slap it on the grill, you want it to be extremely hot so you can sear it, and then you close it and you step away. You come back a few minutes later, you flip it once, and then you let it sit for another minute or two, take it off the grill, you let it rest. If you'll notice, what doesn't happen in the middle of grilling a steak, we're not picking it up, poking it, we're not flipping it back and forth, we're not constantly opening the grill. We're letting the process run its course. And ultimately, I really just want to bring this back to, just because you're holding an investment doesn't mean that you're not doing a good job investing. Sometimes the best decision is not making a move and holding, even if the market's down, right? But ultimately, I really want to emphasize, make sure that you trust the process. You're working with an advisor that you trust when you spend time putting these investment plans together. There are certain cases where it does make sense to change your investment strategy, though. It's not always a follow the process blindly. But what I do emphasize with folks is make sure that you're not changing your investment philosophy based on what the market's doing. More likely, you may want to change your investment philosophy based on your lifestyle or your goals or your circumstances changing. That's a more appropriate time to reevaluate, how am I invested? Does this still make sense? And that's something, again, a good advisor will spend time with you doing. That they won't limit it to, you have one annual meeting and you need to hold off all of your questions until then. We always encourage clients, if things have changed, we aren't mind readers, so please let us know. We want to make sure that whatever we have set up for you currently still makes sense given the new dynamics that are existing. As far as when you should review your investments, one of the number one mistakes that I see people make is they check it multiple times a day, especially for long-term retirement investing. You'll drive yourself crazy. I would not encourage anyone who is not an advisor monitoring people's accounts to check daily. Quarterly, if you're someone that likes to take a look at this regularly, I think is a good clip. You usually end up with quarterly statements to go along with things, so that ends up being a really convenient time to take a look. Semi-annual or annual reviews with your advisor are more than appropriate. And again, semi-annual or annual is great, but if big changes occur along the way, I know we always want to be aware of those changes occurring. So by all means, feel free to reach out to your advisor if you have questions or something dramatic has changed on that side. We do have a question that's been submitted today for our Q&A segment. The question is, how do I know if the investment advice I'm receiving, especially if it's online, is credible? And this is great because we talked actually and touched on this a little bit earlier in the episode. Credibility is important, but I think a more important question, to do a slight diversion on this, is not just is it credible, because it may be from a credible source. There are plenty of fantastic sources out there that really know their stuff and outline the strategies, the processes, or the investments that they are writing or talking about really, really well. But it's less about credibility and more about, is this relevant to my circumstances, is really the question I think that should be asked. So how do we know if it's relevant to your circumstances? Well, one, is it personalized advice? If it's not personalized, it may or may not be relevant, but that's on a very case-by-case basis. Point two, does the individual who's giving this advice understand what your goals are specifically? Because if it's not personal and it's not tailored to your goals, it may not be relevant to your scenario. And then three, is there a dialogue that exists so that you're able to ask questions, get clarity? The person or advisor that you're working with is able to ask you questions to understand your scenario. I think those are really the more important points. And I would emphasize the internet and plenty of resources online are fantastic. As advisors, we use them all the time, but the reality is knowing how to apply that information to your specific scenario. To wrap up today, I just want to thank everyone for joining us on this episode of Invested in You, brought to you by Community First Investment Group. We're here for you now, here for your future. We hope today's episode helped you feel a little bit more prepared as you move forward in your financial journey. Be sure to check us out on Facebook and LinkedIn. You can visit us online at cfigadvisors.com to connect with our team or ask any questions. And we'll be back on our next episode, which will be covering Estate Planning 101. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Securities and advisory services are offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA SIPC. Insurance products are offered through LPL or its licensed affiliates. Community First Bank and Community First Investment Group are not registered as a broker-dealer or investment advisor. Registered representatives of LPL offer products and services using Community First Investment Group and may also be employees of Community First Bank. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of Community First Bank or Community First Investment Group. Securities and insurance offered through LPL or its affiliates are not FDIC insured by FDIC or any other government agency, not bank guaranteed, not bank deposits or obligations, may lose value. There is no assurance that techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of these strategies. Investments involve risk, include possible loss of principal. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly.